Welcome to this outlook for 2017. I'm Julia Lee, an equities strategist at Bell Direct. And with 2016 almost at close, the Australian share market looks to have gained around about 4% for the year, or if you include dividends for the ASX 200 index, up by 8.4%. So as you can see, dividends were responsible for about half the returns from the Australian share market this year. In terms of sectors though, we saw quite a large divergence in terms of performance and also different themes which drove performance. On the plus side, we saw the best performing area being the commodity space. The material sector, which includes BHP, Billiton and Rio Tinto, was up by 41%, and energy also receiving a boost as oil prices recovered from the lows that we saw. So energy up by 12% and the industrial sector up by 6%. On the flip side, we've seen quite a bit of disruption in the bond markets, and that means some of the high-yielding, high-growth areas did suffer as a result. We saw the telecom sector, the worst-performing area, down 10% for the year. Financials were down 4%, and we also saw the tech sector down 2%. If we have a look at what's happened in terms of performance across major markets, this one shows that the Australian market has underperformed over the last 5 years, while the Japanese market and the US stock market have outperformed. And the reason I've put this chart up is because recently we have seen US dollar strength, and this is expected to continue into 2017. If we do see US dollar strength, one thing that Australian investors may want to consider is investing offshore, because when you're invested offshore, you want to see the Aussie dollar weaken while you're investing overseas. Otherwise, looking at companies with high exposure to overseas revenue is also a way to benefit from this theme. But the big story in the second half of the year has been the yield plays, where we have seen the yield areas coming under pressure. This chart has lots of lines, but I think the key thing out of it is that all these lines represent a high yield area, whether it's the utility sector, the property sector, the telecom sector, Sydney airports, or transurban. And what you can see from this chart are that the inflection points and turning points, the highs and lows, tend to have occurred at the same time. And that's because the key thing which has impacted on high yielding plays has been what has been happening in terms of the bond market. So if you want to know how your high yielding investments are going to go in 2017, watch bond prices. In particular, let's have a look at this long-term chart of US Treasuries from 1966 to 2016. You can see that we've seen bond yields decreasing from 1981 to the beginning of this year. And that's had a positive impact in terms of the share market, as well as in terms of these high-yielding plays. But recently what we have seen is that we have seen an inflection point in terms of this very long-term graph that we've seen and long-term trend that we've seen in bond yields. So if we have a look at the last 1 year in terms of US Treasuries and what the yield looks like, you can see from this 1 year chart in July we saw yields bottoming out, and then we have seen a rapid rise in US bond yields, and that's of course caused trouble for those high yielding plays, often called bond proxies, because they follow the bond price. And of course, bond yields have a negative correlation to the price. So as bond yields rise, what we see is bond prices falling and those bond proxies falling as well. So going into 2017, just be careful of those high yield plays, which are often seen as safer investments because they may be anything but safe in 2017, especially if we continue to see these bond yields steepen or rise. But the key positive story of the year has been commodities. Commodities have been an outperformer. In fact, looking at some performances in the year to date, we've seen Whitehaven Coal up by a massive 306%. Fortescue has gained 235% for the year to date. South 32 up by 167%. And even the majors like BHP Billiton gaining 49% and Rio Tinto up by 38%. If you're wondering if the run is over for these commodities, the upgrade cycle has still really just started. And you can see that because there's still a big gap between spot price or the market price of commodities and some of the forecasts that are in the market by different broking houses. Of course, the key to watch is still going to be China in terms of these commodity prices, but with the upgrade cycle still in its infancies, commodities should continue to outperform and that momentum should continue in the new year. The Trump trade, of course, has dominated the last part of 2016, and this has been good news for shares, but bad news for bond prices. And if you're looking at that Trump trade to continue in 2017, it's basically buy shares and sell bonds. If we have a look at individual stocks, so those building companies which are exposed to the US have seen a very nice boost, James Hardie as well as Lend-Lease. And if you're looking for that US exposure, there's stocks like Austal, which is a shipbuilder with lots of US Navy contracts, also Aristocrat Leisure, Amcor and Macquarie Group. Healthcare has also been a beneficiary because of the strength of the US currency, or rather the weakness of the Australian currency. Stocks like CSL as well as Main Pharma, and of course financials doing well in an environment where interest rates are expected to rise. So remaining overweight to the financial space, even though being wary of some of the domestic risks stemming from the apartment market here domestically. But look, going into 2017, it looks like in terms of style, value might dominate. And some of the things that you might want to look for is a low debt to equity level. And that's because debt becomes more expensive as interest rate rises, and then growth at reasonable prices. And certainly towards the end of the year, this is a style that has outperformed. For example, I'll leave you with a scan on Bell Direct's very popular strategy builder, which you can do through the website once you've logged in under the client section. And here we're going to do a scan for a debt to equity ratio less than 40%, so quite conservative, a PE ratio less than the market, so less than 16. We still want to see a bit of growth there, so revenue growth which is greater than 5%. So the last half year revenue growth, more than 5% growth compared to the last full year, and also just having a look at a positive price performance over the last 13 months, so ruling out some of those stocks that have been falling. And look, when we scan this and we back test this particular scan, what we find is that the 6-month return on this particular strategy, if you had renewed this strategy every 3 months, is 23.8%. So you can see there's been some big outperformance in terms of the market, and some of the names that you may be familiar with that have come up on this scan, including GWA, which does kitchen as well as bathroom fixtures, BlueScope Steel, the steel maker and steel products maker, IMF, the funder of class actions, and Shine, which is also in that legal space. So this is just an area that you can use. This is the Bell Direct Strategy Builder to try and filter down your choices and scan the market using different strategy ideas. And in this particular example, we've just used a value-dominated strategy to scan the market. So in summary, the market has been a little bit higher in 2017, up by about 8.4% once you include dividends, but expected to continue that rise into 2017 with all of the US indices finishing the year reaching fresh new all-time record highs. So the market looking like it's headed higher in 2017. Looking at still being overweight the commodity space, that momentum is expected to continue into the new year, but being very careful around yield, especially as we have seen expectations around interest rates are rising, increasing, and of course overweight US exposure as the US dollar strengthens and we see more stimulus added through the US economy through some of the Trump fiscal policies that he is proposing. So that's it from me this year. Wishing you all the best in this Christmas season and in 2017. Hope that the Australian share market is very kind to you. I'm Julia Lee, an equity strategist at Bell Direct. Merry Christmas and a Happy New Year.